Now we should know the basic mechanism for the investment in associate. We understand that there may be intercompany transaction between the parent and the associate. If this is the case, we need to eliminate for the intercompany transaction. Under equity accounting, the eliminations of unrealized profit and loss on intercompany transaction is merely part of the measurement procedure used in calculating the investor's share of the current profit and the retained earnings. Therefore, we will not adjust exactly the inventory accounts, cost of sales, etc., because this is just an adjustment for the investment in associate. But in reality, in practice, different accountants have different opinion. Say for example, someone in the practice say that if this is a transaction between the investors and the associate, if the investors sell something to the associate, they think that it is the investor who have got the profit, and therefore we need to debit the cost of sales. And because it is the associate which have got the inventory, and therefore it's the inventory of the associate that we have to adjust, therefore those accountants adjust that, we will credit investment in associate because it is an inventory of the associate. And therefore they suggest that we need to debit cost of sales and credit investment in associate. The situation is even worse if this is a sales from associate to investor. Some accountants say that if this is a transaction between the associate and the investor, if the associate sells something to the investor, they argue that it is the inventory of the investors that we have to adjust. Therefore, they suggest that we have to credit the inventory. And whenever we credit the inventory, still remember cost of goods sold is opening inventory plus purchase minus closing inventory. Therefore, whenever the closing inventory is smaller, cost of goods sold should be bigger. So therefore, some accountants suggest that we should debit cost of sales and credit inventory. Some other accountants suggest that, I agree that, why? So those accountants agree that it is the inventory of the investors that we have to adjust. Therefore, they agree that we have to credit the inventory. But it is the associate who earned the profit. So that's why we are adjusting for the profit of the associate. And therefore, they suggest that we should debit share of profit of associate. One problem of this debit to share of profit of associate and credit inventory, as well as this debit to cost of sales and credit to the investment in associate is, if we do so, we cannot really reconcile our share of profit of associate with the balance of the investment in associate, right? Because we are debiting different things. And as I've said before, basically this is just a measurement procedure. So for associate, we don't consolidate associate. So therefore, we do not include the sales, cost of sales, depreciation, amortization, administrative expenses, anything of the associate into our financial statements. Instead, everything for the profit and loss, we simply share the profit of associate. Anything related to the balance sheet, we only include in the investment in associate. Therefore, for this course, for this subject, we will use the simplest way. So whenever there's a profit and loss implication, we simply debit share of profit of associate. Whenever there's a balance sheet implication, we credit investment in associate. Therefore, no matter this is the sales from the investor to associate or from the associates to investor, we simply debit share of profit of associate and credit investment in associate. Take an example. Here in this case, T1 is the investor, and this investor owns 25% of the voting shares of T2. So 25% significant influence, so we treat T2 as an associate. Assume that T2 had 600,000 of this inventory on hand at the year end. So because T1 sold something to T2, therefore T2 have got some closing inventory from T1. 100,000 is the inventory value recorded by T2. Tax rate 30%. And the original cost to T1 is 420. So potentially there can be an overstatement of inventory amounting to 180,000. Right? Because originally it should be 420,000. Now T2 recorded as 600,000. So potentially the unrealized profit or overstatement of inventory is 180,000. But this is only a 25% associate. We don't share 100%, we share only 25%. So therefore, we adjust only 25% of this 180,000 because this is a 25% associate. And actually, there will be a 30% tax effect. So therefore, we share only 25% of the 180,000, that means 45 after tax. So that's why the adjustment should be only 31,500. If this is a subsidiary, we will debit cost of sales and credit inventory because we have to reduce the inventory figure. But this is not a subsidiary. For associate, instead of debiting cost of sales, we simply debit share of profit of associate. We don't credit inventory because this is not a subsidiary. For an associate, we simply credit investment associate. This is what we have to do at the end of the year. Next year, if we have to repeat this journal entry, of course, we will debit retained earnings because last year it was a share of profit of associate. This year will be retained earnings. If we simply repeat this journal entry, that means if this inventory still remains in our warehouse, we will credit investment in associate. Take one more example. In this case, the investors own 20%, 20% significant influence, so this is an associate. So S, being the investors, sell 200,000 of inventory to A. The original cost was 140,000. So potentially there can be an overstatement of inventory amounting to 60,000. Right? It should be 140, but we treat it as 200 in our warehouse. Potentially it was 60,000 overstatement of inventory, but only 1/3 remains. The other 2/3 has been sold. So therefore, out of this 60,000 potential overstatement of inventory, only 1/3 remained, and we account for it after tax, and we share only 20%. So again, if this is a subsidiary, we debit cost of goods sold and credit inventory. We don't debit cost of goods sold. This is an associate. We simply debit share of profit of associate. We don't credit inventory. We simply credit investment in associate. Of course, we'll share the current year profit. So the current year profit is after tax 1 million minus 200,000. That means 800,000. We share 20%. We simply debit investment in associate and credit the share of the profit of associate amounting to 160,000.